On this Melbourne Cup day, Governor Lowe and his board met and they kept interest rates on hold. It is an interesting time in our economy at the moment because the RBA is wrestling with one big problem, and that is the growing amount of household debt. Okay, we are starting to see household debt to GDP ratios increasing, and that's concerning. What we would like to see when we see low interest rates is the level of saving, so household saving actually growing, and we're not seeing that, and that is concerning the governor and the board. In addition to that, also the price movements in Melbourne and Sydney when it comes to bricks and mortar. Property prices are continuing to grow at very high levels, and we're still seeing investors heavily active in the market. Now, naturally, we're a business that provides the opportunity for investors to get in the market, but even we're concerned about the levels of investor activity. When we start to see, almost 60% of all new loans in New South Wales going to investors, that is concerning for us, considering the long-term average has been between that sort of 30 and 40% range. Now, what does that mean? Does it mean that we're actually seeing a transition of our two big capitals into a new market environment? Meaning that traditionally we've been 70% owner-occupier and 30% investor. Are we seeing our big cities now places where investors are looking at bricks and mortar as a long-term opportunity, like what we see in New York and London, where we're actually seeing household percentages of investors or people who rent in those cities around that 70% mark? Now, that could be the case. We could be transitioning more towards most people in our big capital cities, our big service and financial hubs, now being pushed out of the market. And that is a conversation around affordability. Housing affordability is getting harder and harder for many Australians to get into our big markets. Now, the government obviously is aware of that, and it is very much a supply story. We're seeing at the moment during the spring selling season some of the lowest supply levels of property on the market, and that is also adding to the increased valuations of properties that are going through Melbourne and Sydney at the moment. Clearance rates in the 80% absolutely indicates that property prices are continuing to rise in those areas. So on one hand, the governor and the board have got challenges around, potentially dropping interest rates if the economy needs more monetary stimulation. But on the other hand, it's who's actually using that money. And I think they want to claw back households from using more and more debt and getting ourselves into a position where the economy is getting pressured by household debt. So it's a challenging situation, and I suspect we'll hear more from APRA, the Australian Prudential Regulatory Authority, getting involved in this conversation. We may see some further tightening in regards to some lending policies around households borrowing money. We obviously, in other states, we need it. We're seeing obviously in Perth and Western Australia, net migration from that. So we're seeing a decline in people actually living in Western Australia, moving back to the eastern states because there's more job opportunities there. So we're seeing a housing market with lots of oversupply, lots of vacancy rates. In terms of running around Australia, the strongest economy is New South Wales, followed by Victoria, and then we're talking about Canberra, and then South Australia, then we go into Brisbane, and then we've got Darwin and Northern Territory. So it is an interesting mix because, again, monetary policy should be about stimulating jobs and business to borrow money in those other centres as they struggle to correct themselves after the big mining boom that we've seen. So it is an interesting time. I also see confidence is up. Now, households are willing to borrow more money because maybe they're feeling a little bit more confident in their job. Unemployment rate has dropped down by 0.1% in the August data that we've seen to date. So we're now seeing an unemployment rate nationally of around 5.6%. We still have spare capacity, and we're not necessarily seeing all of those translate to full-time jobs. But is that another example of a changing economy and a changing way in which people are employed in this new economy, this technology economy that we're going to be moving to over the course of the next 10 or 15 years? It is an interesting time. I don't see interest rates being dropped or reduced this side of Christmas, but I think if we see some shocks to the global economy, then we will see some further rate cuts in the Australian market, so long as we can rein in that household spending and start to see ways in which we can incentivise business lending to try and drive more jobs. That's the time that we should then see confidence around the economy and then monetary policy actually going the other way and we see rising interest rates. But I don't see that in 2017 at all, but it's early days yet. So interest rates on hold for this Melbourne Cup day. I hope you pick a winner in the Cup, and I'll speak to you next month.